Good morning, everyone, and welcome to BGA's Tuesday Morning Coffee Talk. These are our weekly sessions where we provide industry insights to our agents. We share product updates, market trends, policy changes, and marketing that will help agents find the sales to grow their business. We post these on YouTube every Tuesday before noon, and for our listeners on Apple and Spotify podcasts. My name is Trent Zimmerman, and I'm your host. And this week, I have the pleasure of introducing Sheryl Moore, founder, creator, and CEO of Wink Inc. and More Market Intelligence. Sheryl also sits on the Forbes Finance Council and is self-proclaimed the most connected person in life insurance and annuities. But before I welcome her in, I want to give her congratulations because according to her LinkedIn, she finally watched The Big Short. So it was good?
Yeah, it was phenomenal. But I'm a cinephile, so I ingest movies like crazy. I have to say, it's probably one of my top five. It was amazing.
It jumped that high that quick.
Yeah, but I'll tell you, it really made me question the ratings agencies in the life insurance business.
Okay, you said that, and I want to know why.
Well, I've always felt like there's a possibility that they are overly swayed by the money that they make from the carriers and that influences their ratings. But what I saw on The Big Short was borderline fraudulent. So, I mean, that really got my attention. I know that it's just a movie, but I also know how the 2008 collapse fell out, and it's legit. So I was disappointed, to be honest with you.
Yeah, I mean, it's just a movie, but so is Titanic, and we all know how that ended.
Yes, absolutely. Good analogy.
All right, so before we dive into insurance questions, let's get a little background on you. I see that you went to Grandview University, but from my understanding, you did not attend any of your own graduation celebrations, even though you graduated summa cum laude. What's the story behind
So, yeah, that's absolutely true. I'm amazed that you know that. So I went through in vitro fertilization for over 10 years. My first husband was a police officer who went to prison and left me a single mom of three babies in diapers all at the same time. And my second husband, whom I met years later, did not have any children, had never been married, was my grade school sweetheart and my boyfriend from when I was 11 years old. So we decided that we wanted to have a child together, and we began the in vitro process. And I was actually going through the process of a bedridden period at the time that I graduated. So I was in bed for 2 weeks. I couldn't get up. We were hoping that the end result would be a baby, and I ended up losing it. But I did not make it to my graduation ceremony. And I have to tell you, that is one of my biggest regrets. I mean, especially in light of the fact that I didn't end up pregnant. I really wish I would have attended the ceremony.
Well, I also heard something on, maybe I read on your website that you were organizing your whole place as well, or is that a different story?
Well, different story.
Okay.
My husband and I are real estate investors for a side
Uh,
hustle, as if I need a side hustle. I also run a bed and breakfast for another side hustle. But we had just rehabbed a house and put it on the market. And the day before graduation day, the house flooded. We had torrential rains in Des Moines, and the entire basement, which was finished, flooded. So that was just one more reason why I wasn't available for the
got it.
ceremony.
Okay. Well, so how did you end up in the insurance industry as a whole then?
Yeah, so that's an interesting question. I live in Des Moines, Iowa, and a lot of people assume that I moved here because of my work in the life insurance industry, but I'm actually a Des Moinesian. So I told you I had an ex-husband who went to federal prison and left me a single mom. When that happened, I had been a homemaker. My oldest child was born with birth defects and health problems that required him to have surgery every year, and he couldn't be in daycare. So I was in the unfortunate position when my ex-husband went to prison that I needed to find a job. And I wanted something where if my employer shut down or went bankrupt, that I could walk across the street the same day and pick up where I left off. And so in Des Moines, Iowa, that means insurance. We are the largest insurance capital of the US and second largest insurance capital of the world. And I like to tell people we're also the annuity capital of the world. So it was a logical decision for me. And I started off in telephone customer service for the company that was the #1 seller of indexed life and indexed annuities. Today, they're known as Athene on the annuity side and Global Atlantic on the life insurance side. But I worked my way up very quickly through the company until I was in charge of competitive intelligence and product development. At that time, they were part of a mutual holding company. So I worked for the holding company and supported 5 different life insurance companies in their product development and competitive intelligence.
So you went from competitive intelligence to starting your own firm, and you've created quite the niche for yourself with a good following. How did you end up making the leap?
So I loved my job. I valued it very much. It was very much an entrepreneurial company. I mean, I love to suggest cost saving ideas and see them implemented. I mean, it was a really fun atmosphere, but the company changed their health plan so that my son's surgeries were no longer covered. And I was kind of in the unfortunate position to have to find a new employer. I didn't have a choice. So I left that company and went to work for Principal Financial Group. I made it 8 months there, and then they demutualized. And they decided that having somebody who did competitive intelligence put their stockholders at risk, and they eliminated my position. I was, I guess I would say, panicked because I had such a specialized job. You know, I'm not an actuary, but I did product development. Normally, if you work in product development, you need to be an FSA. And my job was highly specialized. There were only 2 companies out of the 100 companies in Iowa that had a competitive intelligence role for life insurance and annuities. One company was a company I'd left 8 months previous, and the other one was the one that gave me my pink slip. So I really didn't have a choice but to start my own company. And I knew that when I had worked for the company that's today known as Athene, I had recognized that there was a need for a central repository of indexed annuity products and their features. And so that was my initial product offering, but we've built it out in a really huge way throughout the past 19 years that I've run my own business.
Right. Now you have Wink Inc. and More Market Intelligence. What is it each of these companies do?
So More Market Intelligence is my consulting firm where I work with select insurance companies to help them with their competitive intelligence, product development, entering the life insurance or annuity market, strategy, what have you. Wink is a market research firm, and that's really where most people know us. Not only do I have that annuity specs database that now houses product information for all deferred annuities, we also have the life specs database, which does the same thing on life insurance. But what we're most known for is tracking sales of the products. So if you're familiar with LIMRA, we are LIMRA's biggest competitor. Where LIMRA reports sales on a more macro level, we're very granular. So, you know, they might say Jackson National is the #1 seller of variable annuities. And we would say, yes, you know, Jackson's the #1 seller of VAs, but they have 8 different variable annuities. Their Perspective 2 product is their #1 seller, and they sold this much of it through banks, this much through RAs, independent BDs, wirehouses, et cetera. So that's what we're known for because of that very granular level that we're reporting on. It's invaluable to insurance companies and assist them in their product development efforts.
Yeah, that's a great distinction because you know, the top IUL for us that we look at might not be one that we sell a lot of. It might be a centralized product just for broker dealers or a bank.
Mm-hmm.
So it's great information for us. Now, you have a newsletter that has quite the following, and you've already heard this story, but when we decided to interview you, the guy who sits right next door to me lost his mind because he's been reading your newsletter for 10 years. So what's your readership at now?
I quit counting at 100,000.
Okay.
So it's amazing. It's a free newsletter. We really encourage anyone that's a stakeholder in the life insurance or annuity market to sign up, just because what we do is we aggregate all the news about life insurance and annuities that hits the web each week, and we put it on our blog and package it in that free newsletter. So it's really useful to keep up with what's going on in the market.
Absolutely. So let's start diving into insurance related questions and more the deeper dive. But before we do, I want to get just temperature check. Currently, how do you feel the insurance industry as a whole is doing?
I'm really excited that annuity sales have popped up so much. It means that more people are becoming aware of these products and being able to make a decision about whether or not they're right for them. I'll be honest that I'm a little disappointed with life insurance. I've become disenfranchised with index life just because of the games that have been being played with illustrations. But I'm also sad about life insurance because we've seen universal life and guaranteed UL dwindling away. The sales are very nominal at this point. And there's just a huge problem with Americans being underinsured or not insured at all. And it doesn't really seem like we've been able to crack the egg and make a difference there. So I'm a little disappointed.
Okay. Well, you did give me a good opening to ask about annuities because they are very hot right now. And we
Yeah.
see a lot of that driven by interest rates, but to a lesser degree, how much they've improved as products over the last decade. So as rates come down, do you think there will still be some staying power for the annuity industry?
Absolutely, because the number one fear of Americans is running out of money in retirement. Matter of fact, I was just reading about Allianz's retirement income survey this morning, and it showed that 2/3 of people are more afraid of running out of money in retirement than they are of death.
Hmm.
So this is a huge value proposition for annuities because annuities are the only instrument that can guarantee an income you can't outlive. And so I'm very optimistic about the prospects of annuities, despite the fact that rates have come down a little bit.
Hmm. Now, another area of the industry, we've seen a lot of insurtechs come and go during COVID. Have you seen them make any lasting impact on the industry today?
On the annuity industry or on the
Life side.
life side? Okay. What's interesting is I've kept my eye on that from the very beginning because I was like, oh boy, these guys think they've got it figured out and they're doing something that, nobody else has been able to do. So I watched with great interest all these insurtech firms that have come into the space over the past decade. And I'll be honest, it's not like I'm a swami and I've, got the hat in my crystal ball, but I predicted that, they would not be successful in their efforts to sell life insurance direct to consumer. We've had, AIG and their Matrix direct to consumer platform, and we've had other similar platforms in the past, which really haven't moved the needle on life insurance sales. So I projected it would be, much of the same with these firms. And what we've seen is that their strategy was not working out for them, and they've had to pivot to a plan B and work with insurance agents. So it's been really interesting to watch.
And so this uninsured gap you talked about before, uh, insurtechs came and went, but is there anything you're seeing now that's starting to move the needle and start getting people coverage?
Well, I'll be honest. I love and I hate TikTok and other social media platforms where you see people pitching life insurance. I'm grateful for it just because it gets the conversation going about life insurance and has more people, seeing the value of the product. But I'm also embarrassed to some degree, because I will see people out there pitching index life with guaranteed 45% returns or things like that. So there's a lot of abuses happening out there, but it also puts life insurance into the conversation so that people are talking about it at the very least.
Hmm. So in the independent system, we were talking about this before with the top variable products and how those might be mainly in wirehouses and broker dealers. Us as a BGA, we're working more with independent agents. So what are you seeing in your data that's being sold most by independent agents?
Well, definitely index life insurance and indexed annuities are the bread and butter of independent agents. Now, MIGAs have come in and stolen some market share from indexed annuities since fourth quarter of last year, just because rates have been so attractive. But I would say indexed insurance products really are the bread and butter of independent agents.
So good lead in because, and you were talking about the games that are played with illustrations.
Mhm.
What should our agents be looking for, and any advice and insights on how to sift through the good, the bad, and the ugly?
Well, what I tell agents is, first of all, you need to do your due diligence on the carrier that you're doing business with. And that doesn't just mean financial strength or looking at their balance sheet, but also looking at their customer service, how they treat you as an agent, what is their renewal rate history like, and how do they treat their inforce business. Those are all very important things to know before you make the decision to write with a carrier, but then evaluate the product. And I'll say it's harder than ever when it comes to index life to tell the truth from the BS. Just to keep it real with you, I see a lot of games continuing to be played with illustrations despite AG 49B. We're seeing the development of new loans with bonuses that really help the illustrations look more attractive. And so I would encourage agents to be analyzers. That's what they really need to be, because um, they got to look out for themselves. I mean, they have you guys to help out, but some of what I'm seeing is even more complicated than FMOs and BGAs can really analyze. So you have to scrutinize the products in a way you never have before.
Hmm. And now with AG 49, do you think as a whole the industry has become more honest? Or do you think there's still those games being played in the illustrations? Of
Yeah,
course,
the
you
games are
already said
still
they're
being played. I would just say that the carriers are doing better at being sneaky about it.
okay. And is there any risk, taking out the loan provisions that we're talking about, that there are some carriers out there under promising and being hurt by this new regulation?
You know, what's interesting is that most of the carriers really do want to do right. What I hear from them is, Sheryl, we feel like we've been backed into a corner and we're having to succumb to playing these games because we're losing market share by being the good guys and not doing it.
Hmm,
So they want to do right, but the environment is such that they're kind of backed into a corner, to be honest with you.
right. And one of those games we often see played is aggressive cap rates at the intro and then dropping later on down the line.
Mhm.
Have you done any comparative benchmarking on companies that would show a more complete picture on how they treat cap rates?
Well, so we have index life and index annuities, which honestly both have a problem with how inforce renewal rates are treated. We have less companies publishing their inforce renewal rates on the index life side than we do indexed annuities. And I do have that renewal rate information, and we're going to try and develop a software program so that people will have access to that information. But what I tell agents is, if the insurance company doesn't publish their inforce renewal rates, that's probably a good opportunity for you to ask why that is.
Hmm. Now, another piece that we're seeing a lot more growth in is volatility controlled indexes. They're
Mhm.
becoming extremely popular. And I know there's not a lot of back data on this as there are newer indices in the industry, but from what you're seeing, are they up to snuff?
The first, what I call them hybrid indexes, and we track sales at an index level on indexed insurance products. So I can tell you, they're most prevalent on the index annuity side, and close to half of all allocations are going to hybrid indexes. When I first saw these come into the market in 2012, I was like, oh gosh, these are complicated indexes and frequently have fees attached to them, which have the effect of drag on the performance of the product. And they're often brand new with no history. So I was scrutinous of them when they first emerged in the market more than a decade ago. I will tell you that the data that I have seen, which I do not produce the performance data on these products, I do research them though, and I frequently hit their microsites where they have performance data. And thus far, I would say they are not measuring up to what they've illustrated. So I am seeing a lot more agents flying back to the straight S&P 500, especially since rates have been so good. But it's important to understand that these hybrid indexes, even though they perform better than domestic indexes like the Dow Jones and the S&P, they're not intended to perform better than those indexes. What they're actually developed for is to provide more steady returns. So instead of like on the S&P 500 earning 6% one year, 0% the next, and 0% the next, what a hybrid index will do is provide a return of 2%, 2%, 2%. So the net effect is similar, but you're getting more steady returns on a volatility controlled or engineered index.
So is there someone then you would see would benefit from this volatility controlled and knowing what a steady return would be rather than a swing from 1% to 6%?
I think it all depends. I mean, to keep it real with you, I'm indifferent on index because what I tell people is you need to allocate a little bit to the fixed bucket, especially if you have an indexed annuity with a rider that has a charge on it, because that can help you avoid that uncomfortable conversation of, hey, why did I get a negative adjustment to my cash value? This is an index product. You told me zero is my hero.
Mhm.
So allocate a little to the fixed bucket. And then what I tell people to do is allocate the remainder of the money equally amongst all available indexing methods. And that's just because we don't know how any of them are going to perform in any given market. So you're spreading out your risk of earning a zero when you do that.
Hmm. Now, you talked about the riders with fees, and National Life and Symetra have added Alzheimer's and fertility riders, and those have become more popular, at least just to talk about. I don't know if we've seen
Yes.
sales hit there. But where are you seeing the market go with riders and benefits on their policies?
Well, living benefits are still really in the spotlight for life insurance products, and I'm seeing a lot of development to those types of riders. On the annuity side, I would say we continue to see a focus on guaranteed lifetime withdrawal benefits. And then we have some companies that are packaging together several features into a single rider. Like maybe the policy only offers 5% penalty free withdrawals, but this rider will give you extra liquidity at 10% penalty freeze. And let's also package in there a guaranteed minimum income benefit and maybe a higher premium bonus if you elect the rider. So rider development is not as active as it was when rates were bad, just because income was more of a focus when accumulation wasn't as great of a story, but we're seeing the focus shift to the accumulation side right now on annuities.
Okay. And so has though that rider development when rates were low uh made these even stronger of an offering now that rates are much higher?
Yeah, the majority of guaranteed lifetime withdrawal benefit riders look at the indexed and fixed performance of the base policy and use that in the calculation of their benefit base value. which is the value that the income payments are based upon. So it doesn't have to be either it's an accumulation product or an income product. What we're seeing now is that most of those carriers have gravitated toward a design that works for income or accumulation. And so, yeah, that has been interesting to watch. But you know what? I got to tell you, I'm still a huge fan of guaranteed lifetime withdrawal benefits with guaranteed roll-ups. Those are harder and harder to find, especially the compounding interest ones rather than simple interest. That's just a really easy story if you're talking income, and I miss that being so prevalent.
Yeah. Well, is there any product or feature right now that you're thinking is being underutilized? I know you're saying those aren't being offered as much, but something that's more widespread in the industry that just isn't getting the traction it deserves.
Gosh, that's a tough question. I guess I would just say overall annuities as a whole are underutilized just because there are so many people that are concerned about running out of money in retirement. Not enough people are talking about the annuity as a possible solution for that. And I'm really concerned about the Department of Labor's fiduciary rule and what that might do to annuity sales and telling that story. So putting me on the spot, I'd have to say annuities.
Well, you're giving me a good lead in as well, because the Department of Labor law is of growing concern for us. And you work with a lot of lawmakers across the country. Do you think it actually has legs?
Yeah, it does. And quite frankly, it's scaring the tar out of me. I mean, when we look at deferred annuity sales, 63% are qualified sales. And that's specifically what the Department of Labor is targeting, is those qualified sales. So, having to be a fiduciary to sell qualified annuities is alarming to me, just because I think that Ma and Pa Kettle are going to be left in the dark, and they're not going to receive the service that they need, just because if you're a registered investment advisor, you normally have to create a threshold and say, I'm going to only work with people who have assets of, say, $500,000 or more. And that means that Joe the plumber is being left out, because the typical annuity sale is only $156,000. So these aren't people that have $500,000 in assets, but they still need the guidance and the tools and solutions that are going to protect them. And so I'm worried that they're going to be left in the dark with the DOL's fiduciary rule.
Yeah. And Corbridge actually released some stats, and I know they reference you and Limra and a few other sources. And so I don't know if this was directly your data, but they had as low as 20% of Americans having insurance outside their employer,
Yeah.
and having that kind of coverage. And we're just seeing less and less life agents, annuity agents, and people having access to that sort of help. And that's a scary number.
Yeah, we're a dying
20%.
distribution, Trent. I mean, we really are.
So you're a huge advocate for the industry as a whole. So and there's two sides to this. What do you want to see more growth in, and what are you excited about that's growing currently?
Well, I want to see more growth in life insurance sales. I have a huge LinkedIn following and tons of really active engagement on my feed. We just had a conversation this week about the use of crowdfunding for life insurance purposes, or people who don't have life insurance using
Oh,
GoFundMe
yeah.
to cover funeral expenses. And I'll have to tell you, I guess I'd say I'm a little heartless when it comes to that, because I don't think that's an excuse. I bought life insurance on myself and my 3 kids when I was a single mom with no child support. I mean, it's just a matter of making it a priority. And I think that I'd really like to see more coverage with life insurance in our nation, just because then you don't have the people who are like, my husband died unexpectedly. What am I going to do? I'm going to lose my house. We need to find ways to take that uncomfortable conversation of what are you going to do when you die, and put some legs behind it so that less people are using GoFundMe for funeral purposes.
We didn't plan this to talk about that, but that is a campaign we've wanted to run for years.
Really?
Yeah, of go get coverage or GoFundMe. And
Yeah,
the data behind the amount of money people make on GoFundMe, it's less than $1,000. And
really.
oh yeah. And the average funeral cost, even if you're doing cremation, is going to be 5,000.
Yeah, it's
We get you there.
12,000 in Des Moines, Iowa.
Yeah,
So I mean, it doesn't take a ton of money to make sure that those expenses are covered, relatively speaking,
right.
but people don't like having that conversation. And I'll tell you, I tried to get my mother-in-law to purchase life insurance. Her husband died prematurely at the age of 62 and fell asleep on the couch and didn't wake up. But when I talked to her and said, "Do you have life insurance?" her immediate response was, "Well, I'm not going to die anytime soon." And it just goes to show that we have a lot of education that we need to do when it comes to the life insurance story. I mean, people need to know, hey, it's less expensive the younger you are,
Right.
or you need it because what if you get sick and then you're uninsurable, or there's so many different variables, and people don't like facing their mortality. So we need to find a way to make that conversation easier so that we can close that underinsured and uninsured gap.
And is there anything you're seeing over the horizon? I know you talked about TikTok and social media and getting the word out there, but is there anything else you're seeing over the horizon that could start to move that needle?
About the biggest thing that I've seen is Life Happens, if you're familiar with them and the work that they do. I mean, I'm grateful for that because then we get a national platform to talk about life insurance. But I'd be interested to see the statistics and how much or how effective that has been from one year to the next. I'm not sure that it's moving the needle, to be honest with you, Trent, but that's what I'm holding out hope on, is because we otherwise don't have a unified voice as an industry.
Right. Well, let's end on a positive note then. You're an ice cream connoisseur, and I want to know what the best mass market ice cream brand is.
So I I am hugely in love with Cold Stone Creamery and their ice cream. I really like mix-ins. So when I was a kid, I would experiment with all sorts of things. And one of my favorites is chocolate ice cream with peanut butter, hot fudge, and grape nuts.
Grape nuts.
Yeah,
Okay.
I know it's not what you'd expect, but the texture is
No.
awesome and the taste combination is phenomenal. So I'm a huge fan of Cold Stone, but they don't have my favorite flavor of ice cream, and that's pistachio almond.
Okay. That was gonna be my follow-up is why is pistachio the best flavor?
I don't know. It's amazing. And you know what? I don't like pistachios themselves. I won't eat them, but I love pistachio flavored, like ice cream, Jello brand pudding. I'm a big fan of pistachio. Is that your favorite too?
It is. It is.
Awesome. Well, you're in the circle of trust now, Trent.
I agree. And here's my perspective. I know I'm interviewing you, but I'm gonna give you my side of this. If any ice cream shop has good pistachio, I now trust them for all the rest of the flavors. And
Yes,
if you have that one first, you know this is going to be a good ice cream shop.
you're right. I have to agree with you.
Awesome. Well, Sheryl, it was a pleasure having you. And now, where can people find you and follow along with your newsletter and the work that you're doing?
So you can follow me on LinkedIn by searching for Sheryl J. Moore, and it's Sheryl with an S. You can find me at winkintel.com. That's wink short for intelligence, Intel. Or on any other social network. I'm Sheryl J. Moore on all the social platforms, and you will see our work cited in newspapers and magazines that talk about life insurance and annuities. Check out our free newsletter on the Wink Intel website and let me know if you have any questions, because here's the thing. I answer the phone still, and every email that I get over 300 emails a day. and I love to help people. So if you need anything and I can be helpful, don't hesitate to reach out.
And I can attest to that because we found you through Pam and Aspire magazine, and you're referenced a lot in Aspire. And she said, we got to talk to you, and you responded within the hour. And so you're extremely reachable. So
Well,
find
I'm an
Sheryl.
insurance evangelist, Trent,
Yeah,
and I can't get the word out unless I have your help.
exactly. So follow Sheryl on LinkedIn. She's a great follow. Go find her at winkintel.com. And then follow, like, and subscribe to the content we're doing. The more that you participate, the more we can strong arm people like Sheryl to evangelize about life insurance here. So thank you all for joining, and thanks, Sheryl, for joining us as well.
Thanks, Trent. Have a good day.